number 16, capital structure policy. A firm's capital structure is a mix of financial securities used to finance its activities, and the mix will always include common stock and often include debt and preferred stock. The debt at a firm can be long-term or short-term, secured or unsecured, convertible or not convertible into common stock, and so on. Preferred stock can be cumulative or non-cumulative, and convertible and not convertible into common stock. A higher fraction of debt indicates a higher degree of financial leverage. The amount of financial leverage in a firm's capital structure is important because it affects the value of the firm.
Managers at a firm choose a capital structure so that the mix of securities making up the structure itself minimizes the cost of financing the firm's activities. And the M&M Proposition 1 states that the capital structures decisions a firm will make, and it will have no effect to the firm because there are no taxes, there are no information or transactional costs, and the real investment policy is not affected by its capital structure. And the equation of it is basically the value of the firms and equals the assets equal the debt and equity. And combining all of that stuff, it's basically a change in financials, so it's just restructuring all the financing. And this is the second proposition, and there's the WAC equation 4 right there.
Business risk associated with the characteristics of the firm is one of the sources of risk in cash flows. Another source of risk is financial risk, which is associated with the capital structure of the firm, reflecting on the effect that the firm's financing decisions have on the riskiness of the cash flows that the stockholders will receive.
And yeah, this is just an example of it. We'll do more of these for the homework, so we'll do that.
The M&M propositions will tell us that M&M analysis will tell us exactly where we should look if we want to understand how capital structure affects firm value and the cost of equity. Financial policy matters. It must be because of venture capital. Yeah. Venture capitalists provide more than financing. The extent of venture capitalist involvement depends on the experience of the management team. One of their most important roles is to provide advice. The cost of venture capital, if the cost is high, but the high rates of return earned by venture capitalists are not unreasonable. A typical venture capital fund may generate annual returns of 15 to 25%, compared with an average annual return for the S&P 500 of about 12%.
So most of the time you'll be getting your money back.
The most important benefit from including debt in a firm's capital structure stems from the fact that firms can deduct interest payments for tax purposes but cannot deduct dividend payments. This makes it less costly to distribute cash to security holders through interest payments than through dividends.
And that's just the equation of how to calculate the tax saving and how to calculate all your tax write-offs. And this is just another example that we'll go through with homework.
The perpetuity model assumes that the firm will continue to be in business forever. The firm will be able to realize the tax savings in the years in which the interest payments are made. The firm's tax rate will remain constant. Interest tax shield benefit. With taxes, the cost of equity can be written as other benefits: underwriting, spreads, and out-of-pocket costs are more than 3 times as large for stock sales as they are for bond sales. Debt provides managers with incentives to focus on maximizing the cash flows that the firm produces, since interest and principal payments must be made when they're due. Okay. Because managers must make these payments and principal payments or face the prospect of bankruptcy, not making the payments can destroy a manager's career. Debt can be used to limit the ability of bad managers to waste the stockholders' money on things such as fancy jet aircraft, plush offices, and other negative NPV projects that benefit the managers personally.
And the cost of debt, financial managers limit the amount of debt in their firms, because if you have too much debt, then it can be detrimental. And if it's too low, the benefits are probably greater than the cost, and adding additional debts will probably increase the value. But just try to have a balance between risk and reward. And bankruptcy costs. Direct bankruptcy are out of pocket for the firms, and it incurs as a result of financial distress. So unless it's like a sole proprietorship, like you won't individually get all your money taken away. And indirect bankruptcy costs are associated with the changes in the behavior of the people who deal with the firm's distress.
Result from conflicts of interest between principals and agents, where one party, the principal, delegates decision-making authority to another party, the agent. The agent is expected to act in the interest of the principal, but agents sometimes have interests that conflict with those of the principal. Stockholder manager agency costs occur to the extent that if the incentives of the managers are not perfectly identical to those of the stockholders, managers will make some decisions that benefit themselves at the expense of the stockholders. Using debt financing provides managers with incentives to focus on maximizing the cash flows that the firm produces and limits the ability of bad managers to waste the stockholders' money on negative NPV projects. These benefits amount to reductions in the agency costs associated with the principal-agent relationship between stockholders and managers. The use of debt increases the volatility of a firm's earnings and the probability that the firm will get into financial difficulty. Increased risk causes managers to make more conservative decisions. Stockholder-lender agency costs occur when investors lend money to a firm and delegate authority to the stockholders to decide how that money will be used. Lenders know that stockholders have incentives to distribute some or all of the funds that they borrow as dividends, and so they protect themselves against this sort of behavior by including provisions in the lending agreements that limit the ability of stockholders to pay dividends and conduct other behaviors. The trade-off theory of capital structure says that managers choose a specific target capital structure based on the trade-offs between the benefits and the cost of benefit, or cost of debt. The theory says that managers will increase debt to the point at which the cost and benefits of adding an additional dollar of debt are exactly equal, because this is the capital structure that maximizes firm value. The pecking order theory recognizes that different types of capital have different costs. This leads to a pecking order in the financing choices that managers make. Managers choose the least expensive capital first, then move to increasingly costly capital when the lower cost sources of capital are no longer available. Some
empirical evidence. Researchers compare the capital structures in different industries, and they find evidence that support this trade-off theory, so it's more peer-reviewed and it's more of a reasonable theory. And the evidence for the trade-off theory is also consistent with the pecking order, and the pecking order is supported by the fact that in the average year, public firms actually repurchase more shares than they actually sell, to kind of keep that balance going.
In choosing a capital structure, managers don't think only in terms of the trade-off or pecking order, but are also concerned with how their financing decisions will influence the practical issues that they must deal with when managing a business. Financial flexibility is an important consideration in many capital structure decisions. Managers must ensure that they retain sufficient financial resources in the firm to take advantage of unexpected opportunities as well as unforeseen problems.
And this is the start to the homework. So what we really want to concentrate on is looking at the numbers, and a firm that is financed completely with equity currently has a cost of capital equal to 15%, and if Modellini and Miller's proposition 1 holds, and the firm's management is thinking about changing its capital structure to 50% debt and 50% equity, they're just asking what it would be if the cost of debt is 10%. So you just look at this equation, it's 50, this represents 50% for the debt and the equity, and then you multiply that by 10% for the tax purposes, and that would get you that final answer. And this one talks about the interest tax shield. So looking from the equation earlier, has an equity cost of capital equal to 15%. There's no taxes. The structure is made of 50 debt, 50 equity, just like in the last problem, and we have to find the weighted average cost. And you just plug it into this specific equation. There, then again, you can see the 50% for the debt and 50% for equity, and all of that stuff. And for the last one, I think, so second proposition, backwards resource companies have a WACC of 12.6% and is subject to a 40% marginal tax rate. Backwards has 250 million of debt outstanding at an interest rate of 9% and 7,500 million of equity at market value outstanding. And they want you to find the equity with the capital structure, and you just find this equation that we talked about earlier, and then just plug in chug and get 15%. And that's it.
Great. And that WACC will be, and the weighted average cost of capital will be used as the discount rate by the firm for capital budgeting decisions. So when they're going to acquire a firm or develop a product, or if they're going to merge with another company or buy a plant or an equipment, they're going to use that weighted average cost of capital as their discount rate. Okay, thank you. Well, these guys are getting set up. What's the markets doing right now? Where's the down? Wasn't it up like 1.3% today? To like 26 what? 24.9. Yeah, it was really down yesterday. And where's oil today? Where's oil today?
Oil's at 67.
$67 a barrel. That's down from like 71, 72. Where's gold today? I heard that thing kind of
a little bit.
Yeah, what's it at 1,200?
1232.
1232, so it's up a little bit. And then where's the dollar to pound?
Dollar appreciated. Yeah.
Dollar appreciated against the pound. Any news? Anything in the news today? Moving the markets? Anything major in the news over the last 24 hours that would be of somewhat concern?
Bombings.
Exactly. Who are they targeting?
Attempted.
Who are they targeting?
Democratic leaders.
Has this ever happened before in history of the United States?
Yeah.
Has it? When?
I mean, mail bombings.
Yes. Terrorism against a political party.
Oh. I don't know.
I mean, are we talking terrorism, or do we consider assassination attempts as well? Because
I think this is a systematic attack on the Democratic Party institution. So I don't think it's ever happened before at this scale. There's probably more bombs in the making. So the market doesn't seem to care, which I think is kind of interesting. And the market didn't really seem to care about the Saudi leader assassination of the journalist in the United States, which is kind of interesting. It's something that didn't really move the markets at all.
They said that China and Russia is listening in on Trump's unsecured iPhone that he uses constantly.
Well, we do that too. To them. But you know, some interesting geopolitical news that really has had no effect on the markets, which I find kind of interesting. Okay, you guys ready?
Yeah.
Okay, did you edit this down?
Yeah.
Okay,
got 7 slots.
Okay, perfect.
Yeah.
So we're talking about dividends. Does anybody shop at REI? REI? Well, they give out dividends. It's awesome. I'd shop there. Okay. We're going to explain what dividends are, the types of dividends, how they are paid, how the company chooses how much they should be worth, how to calculate them. They're also taxed. There's some ways to get around them if it's a private firm. We'll go over that. We'll talk about the benefits. Then we'll define some terms involved in dividends. Okay, so the first term is the payout policy. It's used. It's used to refer to the firm's overall policy. A dividend is when the company wants to give money back to its shareholders. Yeah, a dividend can involve the distribution of cash assets or something else, such as discounts on the firm. When a firm distributes values through a dividend, it reduces the value of the stockholder's claim against the firm. It also reduces the stockholder's investment by returning some of the investment to them. The value of the stockholder receives through a dividend was already theirs, and so a dividend simply takes out the value of the stockholder. So pretty much while we're thinking about this, let's just think about we're at REI, and we bought like a $400, like a nice one, and it's a nice. And REI has this nice policy where you can, they have a 100% satisfaction guarantee. I hate it when people like take advantage of the system and like use the sleeping bag for 3 years and then go and return it with a brand new same one for free. Hate that, don't take it. But, so you get a $400 temp. We'll always come back to this little thing. And so then maybe every quarter you get $15 off of that. All right, let's keep going. Maddie. The most common form is a cash dividend, like we just talked about. You're getting cash on the cash that you just spent. Why would you not go support a great company like this? Generally paid on a quarterly basis. The size of the dividend is set at the management when they expect they're able to maintain the long run in cash. Management can afford to err on the side of setting the regular cash dividend too low because it always has the opportunity of paying extra dividends. I haven't even shopped at REI in probably 2 years and I still get dividends. So it's awesome. Extra dividends are often paid at the same time regular cash payment to ensure a minimum portion of the earnings is distributed to stockholders each year. There's a special dividend. It's a one-time payment to stockholders. It's called the special dividend. They're usually used to distribute unusual large amounts of cash. Keep going to the next slide, kind of describes more about it. It's a dividend that is paid liquidated because it's a large sum of cash, and we don't really want to give that much cash in, the physical, so it's liquid. These non-cash distributions are not thought of as dividends in part because the value received by the stockholders is not in the form of cash, and in part because the value received by the individual stockholder does not often reflect the proportion of the firm. I can read. Okay.
So, dividend payment process. So the process begins with a vote by a company's board of directors to pay a dividend, and then as stockholder representatives, the board must approve any distribution of value to stockholders. And then this is just a exhibit of dividend payment process timeline. Yeah.
Wait, can we go back to that?
Yeah.
So this is pretty much, okay, you bought the tent, over here. This is the tent. You've already used the tent. And then the board decides that they like you, you're a great customer, we want to give you some cash. And then they have to declare it. And on the declare date, this is, we all took accounting, so we've heard this term, declare date. This is when they put it out there to the shareholders, how much they're going to give. And that kind of reflects the company and how much they think that they will grow and how much money they will have in the future by how much money they're giving away. Like when you got paid, you're like, oh, let's go shopping. Or like, oh, I'll give like that one person a couple cash because, I have it and he doesn't. It's kind of like this. So, but in the long run, how many paychecks are you going to get? You only got one. Don't try to spend it all right away. Okay, and then you got the $12 to $15 for your tent. Let's keep going. It's a nice tent, guys.
And then another part of the process, the public announcement. The date on which this announcement is made is known as the declaration date or announcement date of the dividend. And the announcement typically includes the amount of value that stockholders will receive for each share of stock that they own, as well as the other dates associated with the dividend payment process. The price of a firm's stock often changes when a dividend is announced because the public announcement sends a signal to the market about what management thinks the future performance of the firm will be. And if the signal differs from what investors expected, they will adjust the prices at which they are willing to buy or sell the company's stock accordingly. And this means that a dividend decision sends information to investors and that the information is incorporated into stock prices at the time of the public announcement. All right, and the ex-dividend date is the first date on which the stock will trade without rights to the dividend. An investor who buys shares before the ex-dividend date will receive the dividend, while an investor who buys the stock on or after the ex-dividend date will not. And before the ex-dividend date, a stock is said to be trading.
Come dividend or with dividend. The next slide will describe some more. The price of the firm's share exchange on the ex-dividend date, even if there is no new information about the firm. What this means is it reflects the difference in the value of the cash flow that the stockholders are entitled to receive before and after the ex-dividend date.
All right, and then so the dividend payment process. The record date typically follows the ex-dividend date by 2 business days. The record date is the date on which an investor must be a stockholder of record and an officially listed stockholder in order to receive the dividend. And the reason that the ex-dividend date precedes the record date is that it takes time to update the stockholder list when someone purchases shares. The final date in the dividend payment process is the payable date, and that's when the stockholders of record receive their dividend.
So here's the timeline once again. Pence over here, the $15 are over there. Policies.
I'm sorry.
Right. So here is where we kind of change. So now we're going into private companies. REI is a publicly traded corporation, but we can go into private companies like, you know. Okay, so for these, shares are bought and sold less frequently. It kind of gets kind of cool when we get into this because let's just keep going,
Like next
Fewer
slide.
stuff, yeah, next one. Okay, so it is easy to inform, okay, I can,
Remember, we're on the timeline.
we're on time?
No, you have to, faster.
Faster. Okay, keep going, next slide. With the stock, next slide. Okay, here we go. So we're gonna talk about how you can, this is really cool because in a company you can buy stocks and then the managers like they know more than the investors of the company. So the managers are gonna put more money into the company because the investors don't really know how the employees are working or how the market is like actually really doing because they're not there in the source selling the tents. The managers are the ones who are gonna buy more shares of the company and actually get rich off it. Kind of cool, kind of smart. Let's go through it. Next slide. Okay, next slide. The firm, it's awesome. The firm can simply purchase shares in the market. These kind of purchases are open market repurchases, very convenient. The government limits the shares that they can do this though, which makes sense because it influences their stock price through the trading activity. It can also be, it's like insider trading when you can just, cue, next slide. You want to read this one, Jake?
So the tender offer, when management of a company wants to distribute a large amount of cash at one time and does not want to use a special dividend, it can repurchase shares using a tender offer, which is an open offer by a company to purchase shares. There are 2 types of tender offers, the fixed price and the Dutch auction. With the fixed price tender offer, management announces the price that will be paid for the shares and the maximum number of shares that will be repurchased, and interested stockholders then tender their shares by letting management know how many shares they are willing to sell. With the Dutch auction tender offer, the firm announces the number of shares that it would like to repurchase and asks the stockholders how many shares they would sell at a series of prices, ranging from just above the price at which the shares are currently trading at to some higher number. And the stockholders tell the company how many of their shares they would sell at the various prices offered. So So the benefits of dividends. Dividends attract investors who prefer to invest in stocks that generate income. And while it's true that investors could simply sell some stock each month to cover expenses, in the real world, it may be less costly and less trouble to simply receive regular cash dividend payments instead. Yeah.
Next. Okay, so here's where we talk about, you just got paid, we're giving out the cash. Well, what does it mean? It indicates the company is financially strong because the signal, the strength is that they're there, they have a high stock price. The problem with this is that you just got paid, you're not planning into the future. There might be more money in the future. Next slide. If the board of directors of a company votes to pay the stockholders more than the excess cash, then it's going to be coming from selling the equity of other marketplaces that they have. The needs to rate equity in the capital markets will help align the incentives of the managers with those of the stockholders because it increases the cost of managers. Okay, next slide. Here's where we get into the taxing drip. Dividends are taxed, you know, and there's New York Life, I'm sorry to get off, but New York Life has that that retirement 401k where it's not taxed when you take it out, whatever. Next slide. Here is the equation of how to find the dividends and the tax. Next slide. And we actually have the homework problem right here. Dividends and stock repurchases. This is where we can go over how stockholders and companies can rebuy back their shares once they gave the dividends and their expected future stock market is lower or higher. Next slide. It's just greater flexibility. Investors know that the management can always quietly cut back at the end of the repurchasing at any time. This means that in the future, if the cash flows are not certain, managers are likely to prefer to distribute extra cash today. Next slide. The more subtle issues next slide. Here's where we can go from you're paying high dividends, but the stocks are low, and then you have to slowly, over time, cut back the dividends until they equal out. Next slide. One type of dividend, stock dividend, is when a company pays a stock dividend. Okay. Stock splits, another term. It involves distribution of large, these are huge shares. Next slide.
And on the splits, you're gonna cut the stock price in half, and then double the shares outstanding. So then you do it. Cut the stock price in half, you double the shares. Okay. Doesn't affect how much you own or what you own, the worth of what you own. It just cuts the stock in half and doubles the shares outstanding.
They send a positive signal to investors about the outlook that management has for the future, and in turn can lead to higher stock prices.
The best known survey happened 50 years ago. It's not as good as it is today. Times change. Next slide. Next slide. Same thing. So this is when they kind of decide when they can choose how much of the dividends are. You gotta just, you gotta ask questions. How much do we have? How much are we gonna do? You gotta plan into the future about how much money you got. And then you can see how much is rent, how much is food, how much is this. Next slide. Just keep asking questions to just get it in there. And then copyright.
That was Hollywood. Okay, so on the dividends, when companies cut their dividends, the stock prices collapse significantly. If they can increase dividends at a constant rate and grow them at a constant rate, they're going to maximize the value of the shares. So consistency in paying the dividends and growing the dividends over time is the goal and the key to maximizing the stock price. And again, if you're paying out dividends, you're not retaining as much in retained earnings, which is the cheapest source of capital. So you got to be a pretty mature firm that's generating excess cash to be able to pay dividends, and that's usually more mature firms that do that. Okay, let's do the homework. So let's start over there with chapter 10. So that's 1017. Let's try to get through the homeworks as quick as possible so I can finish up the exam. So who's got chapter 10, number 1017?
So on this one, we're trying to find the net present value of this firm. And so if you were going to choose one of these, you choose system 200 because the outcome is positive, and so you make one. Yeah.
The next one, we're suspending the payback period, so go ahead and check out the equipment in year 4, cost recovery, plus remaining costs to recover over cash flows during the year. We have 4, plus the 850,460, $2,660,000, so 4.33 years is the, answer for that, and then since the project's payback period is longer than the firm's target, 4 years, it should be accepted.
So basically, 1019 gives you like a table, so you can really just tell by the table that neither of the projects will work for the firm because both of them exceed 3 years, which is what the firm's target is. So you'll automatically decline both of the projects.
And then for this one, so I don't remember this one.
What you're doing is you're just calculating the MIRR, so you're just walking through the
Okay.
mechanics.
So you take the cash flow, and it's a very similar problem to the other ones we've been doing, and it's, yeah, and you just, they give you all these numbers, so just plug them all in, and then we go to PV costs, and we have PV costs, so we're solving for MIRR, and solve the equation,
So you're just doing the algebra.
yeah. And you get.
That's actually a really cool equation. That'll be on the CFA exam.
Okay, so for 11.6, you just want to find the relevant cash flow and include the sale of price of the machine and the tax on capital gain. And then for the second part, you just change the million to 600,000. And the difference for this one is you find the tax saving on the capital loss.
For this one, we're just looking at the relevant cash flow related to working capital at the beginning of the project. And so we're adding the cash equivalents with the inventory, and then the accounts receivable, subtracting the accounts payable and getting 60,000. And then now we're looking at the end of the project, so we divide the 60,000, and then you do the 1 plus the discount rate plus to the time period, it's 19,318 and 39.
Okay, so this one has 4 steps, and you want to find the incremental cash flow for the operations. So the first step, you would find the revenue, and then you would do that equation. And then for step 2, you'd find the operating expense. And you would want to find the sales of sedans times the annual units, whatever, and then you find like the total operating expense, and then they give you the depreciation, and then for step 4, this is a really long equation, but this is a big answer.
Alright. So for this question, we're using the equivalent annual cost to split. We want the lower one, and so we're taking the opportunity cost and multiplying it by the NPV of the project, and then we take the, we're multiplying the discount rate to the time period again, and then you get 6,569.65 cents. And you do the same thing for B, and you want to choose the lower one, so you would choose B because it has the lower equivalent annual cost.
And for the last one, you're trying to find out when you should sell, so you calculate the NPV for each year, and the third year ends up being the highest, so this is when you would sell.
Yeah, go for it.
$15.8, the question gives us a bunch of information. High-tech firm in Portland raised a total of $90 million in an IPO. The company received $27 with a $30 per share offering price. The legal fees were $450,000. The stock price increased 17% on the first day of trading. So to find the total cost to the firm, you have to first find the underwriting spread. So $3 per share, divide that by $90 million, because that's what it raised. Divided by $30 per share gives you 3 million. So 3 million shares times $3, $9 million. That'll come and play down here. The out-of-pocket expense, it was given to us, is $450,000. And then the last thing you got to do is calculate how much it was underpriced. $30, it grew 17%. So that's what it was at the end of the first day. So it was underpriced by $5.10. That multiplied by 3 million will give you 15,300,000. So when you add those three numbers up, you're going to get $24,750,000 as the total cost of the firm's IPO.
This one is about private placement versus a public debt offering. It's a solution that is public market is more secure, offers more liquidity and higher yield, and private offers faster speed, lower cost, and easy restructuring.
And for 15.26, it's very similar to this first problem we did. So you calculate the underwriting cost. Firm gets $2 per share. How many shares? 4.8 million shares. $9.6 million. And it gives us the out-of-pocket expense, but it skipped that step on the solutions. So the out-of-pocket expense is $270,000. And then to calculate how much was underpriced, again, you're going to multiply it at 17%, so 1.17. It was underpriced by $4.37.38. But just keep it in 3 decimal places for now. You multiply it against the number of shares. You can do the math again, and then the total cost of the firm would be $30,870,000. Yeah, $30,870,000.
Great, thank you.
All right, so for 17.27, the company has 30,000 shares outstanding with a $20 per share market value, and what would be the market value if of the shares if they paid a $5 dividend. So the value of all the current shares is 30,000 shares times $20 is 600,000. The total cash paid out in dividends is 30,000 shares times $5 dividend per share, which is 150,000. So the value of all the current shares would be 600,000 minus the 150,000 payout, which is 450,000. You take that 450,000, you divide it by 30,000 shares, and you get $15 per share, which makes sense because if they paid out a $5 dividend for every, and it was worth $20 before, it makes logical sense they would be worth $15 a share after they paid it out.
Thank you.
So I'm chapter 18, and the first problem is we're calculating the enterprise value of Ford. So you're given the formula VF equals VE plus V after outstanding securities, and that's 11.75 divided by 5 times 3.9 billion shares. And then down here, in order to calculate the enterprise value revenue ratio, you take 80 billion or 80.825 billion and divide it by 1.55 billion, and then you get the value revenue ratio of 0.521. And in order to calculate the total revenue value, you would take this ratio and multiply it by 50 billion, and then you should get 26.1 billion. For the next one, you're trying to calculate the value of a share stock using the constant growth dividend model. And so you take this formula, PO equals D1 over KCS minus G, and that equals 1.25 over 0.12 minus 0.03, and that's 13.89. And then you multiply this by 46 million, and you get 638.94 million. then you take this equation that we did earlier, and you take the number you just got and you add 350 million, and you get a total of 988.94 million. For the next one, you're using growing concern value, and that's VF equals VE plus VP, and that's 40,500,000 plus 5.5 times 1,378,000, which equals 48,079,000, and then you take that number and subtract it by 45,646,000, which is your answer of 2,433,000. And for the next one, or the last one actually, you can calculate the value of FCFF for the first 5 years of a growing annuity using this formula, which is PBA equals CF over the WAC minus G times 1 minus 1 plus G over 1 plus the WAC to this nth number. And you fill in the given values. And then you do the present value of the terminal value using this formula, which is FCFF times 1 plus G to the 4th times 1 plus G over the WAC minus G. And then you fill in those given values, and after you do all of that math, you should get this number, which is 1 billion, roughly like 1,500,000,000. And then you add these two numbers that you just got together, and that equals 2 billion, roughly.
That's great, thank you.
Sure, yeah. So we'll start with the ones that came first. So on 13.6, they give you, you have a dividend of $1.10 for 1 year from now, increase at 5% each year after, and the price of the stock is 13.75, so you're going to use the equation for the cost of common equity. So you're going to take the dividend, which is 110, put it over the price of the stock, which is 13.75. You're going to assume constant growth at 5% each year after, so you would change that in a decimal, 0.05, and then you'll get 0.13, and of course you'll translate that into the percentage, which would be 13%. And then the other one is a little bit similar. You're just not doing the common equity, you're doing the preferred equity. So you have the outstanding preferred shares, dividend is $15 per year, price of shares is $107.14. So you're trying to find the after-tax cost of that. So to find that, you would take, again, the dividend of 15 per year. You would put it over the price of the shares of 107.14. There's no growth rate in this because you're finding the after-tax cost. And you get 0.14. You change that into percentage, you get 14%.
Alright, so we have 13.11. Capital codes has a capital structure based on current market value of 50% debt, 10% preferred stock, 40% common stock. Returns required by investors is 8%, 10% and 15% for preferred stock and common stock, respectively. What is capital? Capital's after-tax revenue. Assume that the firm's marginal tax rate is 40%. So we have the WAC equation right here, and then we basically plug in 50% debt. 40% common. 50% debt, 8%, 10%, and 15% here for the common stock. Then we have 40% common stock right here. Plug all that in. Get 9.4.
1315, the question reads, current cost of a bond. You know that after tax cost of debt capital for Bubbles Champagne Company is 7%. The firm has only one issue of 5-year bonds outstanding. What is the current price of the bonds
the coupon rate on those bonds is 10%. Assume that the bonds make semi-annual coupon payments and the marginal tax rate is 30%. So here we have that 7%, we have the 30%. It says we know the after-tax cost of debt, and from that we can find the pre-tax cost of debt by dividing by 1 minus the tax rate, which we have here, 1 minus the 0.3. This becomes, so this becomes 0.07, 1 minus this here, or 10% here. Since the yield to maturity on the bonds is equal to the coupon rate, then we know the bonds are priced at par or $1,000.
Excellent, thank you.
So for chapter 14, we start with 14.2, has to do with the cash conversion cycle. So you're given DPO, DSI, and DSO, and you basically just plug it into this equation, which is cash conversion cycle equals DSO plus DSI minus DPO, and you'll get 65 days. And for 14.4, has to do with the operating cycle. You're given DSI and DSO, and the equation is operating cycle equals DSO plus DSI, so when you plug those numbers in, you get 31 days. And then for 14.12, has to do with the effective interest rate, and you're given the amount borrowed, the stated annual interest rate, and the compensating balance. And so you use these numbers to get the amount deposited, which is the amount borrowed, times the compensating balance, which gives you $27,200. And then you multiply the amount borrowed, you subtract the amount borrowed by this amount deposited to get the effective borrowing amount, which is $312,800. And then to calculate the interest expense, you would multiply the amount borrowed by the stated annual interest rate, and you would get $23,800. And then from these numbers that you calculated, you would plug it into this equation, which is effective interest rate equals interest expense over effective borrowing expense, which ultimately gives you 7.61%.
Thank you.
So here we're going to calculate the cash flow DOL. Here's the formula, 1 plus fixed costs over EBITDA. So in the problem they give you the information. So you'll do the 1 plus $100,000, which is the fixed cost, divided by 250,000, which is the EBIT, plus $5,000, which is the depreciation for the computers, and that equals 1.392.
So to calculate earnings before interest and taxes, you first have to calculate the free cash flow, which you use the present value of ordinary annuity equation, and then just plug in the numbers and solve it algebraically, or you can use the financial calculator. And then to calculate the EBIT, it's the free cash flow subtracted by the initial cost, and then there's no other capital expenditures or increase in working capital, so usually you would add that, but here it's 0, and then you subtract out the 40% marginal tax, and this is what you get.
So the last question is based on describe which is a more realistic method of analyzing the impact of different scenarios on the project. So there's sensitivity analysis and scenario analysis. Sensitivity analysis is basically focused on the effect of a change in a single item, like unit selling price, a change in the number of units, add on a specific item such as EBIT. And for scenario analysis, it's more focused on multiple effects on a scenario on an item, such as EBIT, by changing a number of interrelated variables at the same time. So after comparing these two, even though they are similar, scenario analysis is the more practical tool for stress testing project.
Thank you. Okay, pull out your blue book, and we'll do the last 2 problems. You may want to go ahead and take pictures of that problem or any of these problems. I'm not going to erase these, but I'm going to erase that one. So,
Run through the iterations of that.
yeah, I'm going to do that too. I'm going to do that with the last problem. Okay, I'll just skip over that and I'll do it. Okay, so we were hired. So we were hired by Alexandria. Okay? And we are East Hill Secure. We are basically the top real estate investment bank. We're located out of New York. We also have an office in San Francisco. We have offices in Boston and other major cities, but we are the premier real estate investment bank. And we were hired by Alexandria. Alexandria is probably the top well-known developers. It's a publicly traded real estate investment trust. They build biotech, biomedical, medical office facilities, research and development facilities. Their crown jewel in their portfolio is basically Mission Bay. Okay, so they are the master developer of Mission Bay, and Mission Bay is anchored by the University of San Francisco, which is probably the top research, medical, academic institution probably in the world. Okay, and their focus is on cancer, but they have the top medical school. It's all, there's no undergrad, it's all graduate, it's all R&D, it's all medical, and Alexandria is basically the master developer for the Mission Bay project. And we were hired to basically help them in understanding. East Hill was hired, Alexandria, to basically see if they should develop Mission Bay. Okay, so this was a while ago, and here's Mission Bay right here. There's the Warrior Stadium, and this is all Mission Bay right there. Okay, so it's pretty amazing. If you haven't gone down there, I would go down there. I'd also go to Salesforce Tower, because that's the one of the newest products on the market. And that's it. So, I'll walk you through the underwriting. Okay, and then we'll do the investment decision making matrix. I should be able to do this within less than 30 minutes. We've already gone through a bunch of these problems. It should be pretty straightforward. So what's the first? Valuation methodology, and I have some calculators over here if you want to borrow calculators to help me underwrite this transaction.
Can you grab it over there?
Yeah.
Professor?
Did you have perpetuity? Perpetuity, got it. What do we need in the perpetuity model?
Future cash flow.
What's this year's cash flow? Because they're not going to usually give us the next year if we had to calculate it. And what are we using? What are we using as the this year's cash flow? What's the cash flow that we're using?
Is it the pro forma?
125.
We're using 125 million of what? Net operating income. Okay, so you got 125 million. Okay, and then how do we get next year?
Multiplied by the growth rate.
Which is?
It's the
We need to get through this really quick.
1.02.
So 1.1. So what's 125 million multiplied by 1.1?
Oh, yeah.
What is it?
137.5.
137.5 million. Is that correct?
Yes.
Got it. And then what do we divide it by? What's our discount rate?
12%.
12%. We're not using 10% or 8%, we're using 12%. Are developments of this size risky?
Yes.
Therefore, we would probably use a higher discount rate, correct? So what's 137.5 million divided by 0.12?
1145.83.
Basically 1.15 billion.
Yeah.
Yeah.
Got it. Okay, and then the next method?
One graph.
Got it. And then what's the cash flow we're gonna use?
The net operating income for the next year.
137.5 million. And then what do we divide that by?
Divide that by the, return expectations minus the growth rate.
And did they give us a going-in growth rate?
Yeah, 2%.
So we're gonna divide it by 0.1. This makes it easy, doesn't it? 375 million. When you're dealing with 10%, it's a lot easier. 1.4 billion. Got it. What's the third method?
Multiple.
Multiple. Got it. And what cash flow do we use?
The NOI.
137.5 million. Did they give us any multiples?
Just 12.
Just the 12%? Can I manufacture a multiple from the 12%? How do I do it?
1.
Yep. 1 divided by 0.12. And that gives us what?
8.33. Yeah.
8.33. And what's 137.5 times 8.33?
1145.83.
1145.83 million, or 1.15 billion. Got it. Okay, what's the next method?
Multiple. Oh, sorry.
We did
DCF.
DCF. What's
Discounted
the first
cash
thing we
flow.
need to know?
How many periods, holding period, 5 year?
Exactly. So we're gonna hold it for 5. How many periods do we need?
6.
6, 2, 3, 4, 5, 6. What do we need the 6 year for?
Present value.
Terminal value.
Terminal,
You
yeah.
want to calculate the discount factor of the cash flows first.
Cash flow,
Cash flows, what's the first year cash flow?
137.5.
$137.5. Got it. How do I get year 2?
Multiply that by,
What is it? 1.08.
08.
What's 137.5 times 1.08?
148.5.
148.5. Got it. How do I get year 3?
Times it by 1.05.
1.05. Got it. What's 1.05 times 148.5?
155.9.
What is it?
155.9.
155.9. Got it. How do we get year 4?
1.04.
1.04. What's 1.04 times 155.9?
162.14.
What is it?
162.16.
Great, thank you. Got it. How do we get year 5?
Multiply that by 1.02 as well.
1.02. Got it. What do
Come out
we
with,
get?
Excuse me. I think I screwed up. I don't think we should have times it by 1.04. I think we should have
Okay,
done.
let's check it. So this is 8.
Oh, yeah.
This is 5. This is 2.
So 155.9 times 1.02 equals 159.02.
159.02. Thank you.
Yeah.
And then we do it again at 2? Yep. Okay. So what's 59.02 times 1.02?
162.2.
162.2. And then how do we get year 6 for the terminal value?
Multiply that by 1.01.
1.01. And then what's 1.01 times 162.2?
163.8.
163.8. And then what do we do with that? To get the TV? How do we get the terminal value?
Do minus the,
What are we
the
using?
terminal.
What are we using for the terminal value?
The
14.
0.14, yeah,
Got it.
and then minus 0.1.
0.01, so we got 0.13, so what's 163.8 divided by 0.13?
$1,260.
1,260.
Yeah.
Got it. Okay, and that's in millions. And what do we do with the terminal value?
Put it over your back.
Add last year's cash flow, so it's 1260 plus 162.2.
14222.
1422.2.
Yeah.
Got it. And then what's our expected return? What's our going in discount rate that we're going to use?
Our going in discount rate was 12%.
12. So what's 1.12 to the 1?
1.12.
1.12 to the 2?
1.25.
1.12 cubed.
1.4.
1.4, 1.12 to the 4th.
1.57.
1.57, 1.12 to the 5th.
1.76.
76. What is 1422.2 divided by 1.76?
$808.07.
808.17.
007.
Is that correct?
Yes.
01. And what's 159?
Excuse me, 07. Sorry.
That's okay. I would think you were an accounting major. Okay, what's 159.02 divided by 1.57?
101.29.
What's 155.9 divided by 1.4? 'Cause I love the sounds of calculators. So what's 155.9 divided by 1.4?
111.37.
Is that correct?
0.36.
You
You guys are gonna have to arm wrestle one.
Yeah.
What's 148.5 divided by 1.25?
118.8.
What is it?
118.8.
118?
Yeah.
118? Got it. And then what's 137.5 divided by 1.12?
122.77.
Okay, and what's 122.77 plus 118.8 plus 111.36 plus 101.29 plus 808.07?
1262.29.
1262.29. We're basically 1.3 billion. So how are our numbers coming? Are they close to each other?
Yeah.
That's confirmation right there. That we're doing a pretty good job. We're using a bunch of different methodologies. Okay, so what's the value of the property? What's the value? What are you gonna come up with?
It's like 1.25 bill. It's the cost of development.
Yeah, what do you, how do you reconcile these numbers?
Oh.
I don't like to look at the value of the project yet. I like to try to go through the methodology and look at the evaluation models that are probably the most accurate. You get a nice clustering of the evaluations using 4 different methods. Which ones of the methods do you think are the most accurate? So which one of the methods do you think is the most accurate?
DCF and multiple, bro.
Probably DCF. Multiple, they just gave you an expected return. It wasn't really about a growth rate or anything. So I'm not sure that's very accurate either, but that kind of gives you an idea. And then this one obviously is pretty good because it gives you a growth rate, and then this one is probably your floor. Okay, so it's probably somewhere in between here, right? So what do you want? What do you want to use? Tell me what.
Average the Gordon drive from the DCF.
You could do that, yeah.
Place a little bit more weight on the DCF.
Yeah, you could do that too. That would be logical.
1.34 maybe.
I'll let you guys debate it.
Yeah, can you just use the DCF, or?
You could just use the DCF if you wanted to. If you wanted to weight the DCF, the most. But actually, the multiple and the Gordon growth do give you kind of an indication. But what's nice is they all kind of cluster together. The valuations are nice and tight. So why don't you give me the final value?
2.5.
What is it?
3.
1. Oh.
I said 3.
Yeah. 1.23.
1.23 billion. And what's our construction cost?
1.25.
1.25?
Yeah.
So what's our net present value? Negative what? What is that, like 20 million?
Yeah.
You mean accept or reject it?
Reject.
How much time do I have?
Got about 15.
This is where you do the investment decision making. This is going to be the rule. This is going to be my iteration number 1. We can even do the Larry sing-along on this one too.
What's that?
You'll see, it's like a Sound of Music. It's for finance. Without Julie Andrews, obviously. Let's put. Let's go through the rules. Present value greater than price, do you accept or reject? Okay, let's go through the exercise.
Present value greater, you accept.
Okay. I think I'd like to hear everybody sing along on this one. Okay.
Accept.
So when the present value is equal to the price or the cost of construction, do you accept or reject? Okay, I only heard one person.
Accept.
Okay, when the present value is equal to the price, do you accept or reject?
Accept.
Okay, and when the present value is less than the price, do you accept or reject?
Reject.
And then when the net present value is positive, do you accept or reject?
Accept.
And when the net present value is equal to 0, do you accept or reject?
Accept.
And when the net present value is negative, do you accept or reject?
Reject.
reject.
Who said that?
I reject.
I'm gonna have to,
Nice job, Hans.
okay, I gotta hold myself.
I'm
on
getting it
screen.
back.
Okay, and when the internal rate of return is greater than your expected return, and this could also be the weighted average cost of capital, the WACC. So when the IRR is greater than the WACC, you accept or reject. Okay. And when the IRR is equal to the expected return, you accept or reject.
Accept.
Okay, and when the IRR is less than the expected return, do you accept or reject? Reject. And if the break even is less than 3 years, do you accept or reject? I only heard one.
Accept.
And when the break even is equal to 3 years, do you accept or reject?
Accept.
Accept. And if the break even is less than, or sorry, greater than 3 years, do you accept or reject?
Reject.
And if I know that the break even is greater than 3 years, what do I know about the IRR compared to the expected return?
It's higher.
Nope. If the break even is greater than 3 years, what do I know about the IRR compared to the expected return?
The IRR is less.
Got it. And what do I know about the net present value? Be negative. And what do I know about the present value compared to the cost of construction or the price? Got it. And what if I know that the internal rate of return is equal to the expected return? What do I know about the break even? What? It's gonna be equal to 3 years. Got it. And